Every account you own, your 401k, your savings, your brokerage, the IRS has a claim on every single one of them, except one, and most people who have access to it are not using it. It is not offshore, not complicated, not reserved for the wealthy. It is sitting inside millions of employee benefits packages right now, completely legal, completely available, almost completely ignored. In the next 8 minutes you will see exactly what this account is, why the IRS gave it 3 simultaneous tax protections that exist nowhere else in the entire tax code, and why the financial industry has little incentive to explain it. Meet James, 47, operations manager, 19 faithful years contributing to his 401k. His financial picture looks responsible from the outside, but he has an account in his benefits portal he has never once logged into. The account James ignored is his HSA, enrolled automatically 3 years ago, $340 sitting in cash earning 0.01%, properly used, it should have $14,200 by now growing tax-free toward a 6-figure retirement. The IRS taxes income when earned, taxes gains when realized, taxes withdrawals when taken. The HSA escapes all 3 simultaneously. No other account in the entire tax code eliminates all 3 tax events at once. Your 401k gives you 1 tax break, your Roth IRA gives you 1 tax break, the HSA gives you all 3 simultaneously, 1 account, 3 protections, nothing else in the tax code comes close. Yvonne found James's HSA statement on a Sunday, $340 earning nothing, 3 years of $50 deposits when he needed a copay. She said, "James, this account was supposed to be our 3rd retirement fund." The copay trap is how most HSA accounts die, money in, copays out, balance near zero, never invests, never compounds. The account was designed to grow for decades, most people use it like a healthcare debit card. For 2026 the HSA limit is $4,300 individual and $8,550 family, $1,000 catch-up if you are 55 or older. Every dollar reduces taxable income dollar for dollar, at a 30% rate that is $1,290 in immediate savings annually. James discovered his HSA provider had an investment option, a $1,000 threshold above which every dollar could be invested. He had $340. He had been $660 away from investment mode for 3 years without knowing it existed. The HSA retirement strategy does not require anything complicated: 1 threshold adjustment, 1 index fund selection, 1 decision to pay medical expenses out of pocket going forward, 3 decisions made once. If you realize your HSA has been sitting idle while the IRS was preparing a claim on every other account you own, stay with us, because what comes next is the specific sequence James used and the projection that made Yvonne go completely silent. Yvonne ran the projection that Sunday evening, James contributing $4,300 annually from 47 to 65 at 7%, the number that appeared was $162,000, completely tax-free for medical expenses. Yvonne went quiet for a long time. She then calculated what $162,000 in tax-free medical withdrawals means, against an average retirement healthcare cost of $315,000 for a couple. The HSA covers more than half, from an account they had ignored for 3 years. James said something that stopped the room. "I have been carefully managing 2 retirement accounts for 19 years and ignoring the one the IRS cannot touch." Yvonne said that is the most expensive ignorance we have ever had. So what does James do right now with the account sitting at $340? It is 3 specific moves in 48 hours. It does not require changing his insurance or his employer. Here is exactly where it starts. Step 1. Log into your HSA provider and find the investment threshold setting today. Lower it to the minimum or request elimination entirely. This single move unlocks the account's actual function. Most people have never clicked it. Step 2. Maximize your 2026 HSA contribution before your tax filing deadline, then invest everything above your minimum cash threshold in a low-cost total market index fund. The IRS untouchable account needs full funding to work fully. Step 3. Start paying medical expenses out of pocket and document every receipt, digital or physical, no expiration. You are building a tax-free withdrawal reserve that grows every time you visit a doctor. James contributed $4,300 in February, deducted it on his 1040, saved $1,290 in taxes immediately, invested $3,300. The account earned $231 in its first year of investment mode, more than the previous 3 years combined. Yvonne said the IRS built a loophole and put it inside your employee benefits and most people scroll past it every open enrollment. James said not anymore. He has not scrolled past it once since that Sunday at the kitchen table. The account requires 1 qualifying condition: a high deductible health plan, 2026 minimum individual deductible $1,650, maximum out-of-pocket $8,300. Most employer-sponsored plans already qualify. Most people are already eligible and do not know it. If this video gave you knowledge your financial advisor never did, share it with one person who is also scrolling past this account every open enrollment. That share costs nothing and could be worth $162,000 to someone you care about. Every week on Health Vault Wealth we find the one healthcare financial strategy most people have access to and almost nobody activates. Not complex, not exclusive, just clear and specific. Subscribe now. James still logs into his HSA every quarter, not to pay a copay, to watch it grow. I spent 19 years protecting 2 accounts from the IRS. I had a third one the whole time they literally cannot touch. It was always there.